For the normal retail investors, it's incredibly difficult to beat the business sectors, which is the reason the vast majority will generally put resources into files over a drawn-out. Beating the business sectors requires a profound information on the ongoing business sector circumstance outside factors, and also a lot of karma. That makes financial backers like Warren Buffett exceptionally regarded, with millions attempting to recreate their way of contributing. Anyway, there's one individual who's in many cases neglected in these conversations, somebody who's generally outflanked not simply the S&P consistently for 30 years, but has beat even the likes of Berkshire Hathaway and Peter Lynch in terms of annualized returns. I'm discussing Jim Simons and the Medallion Fund. The asset has had a normal return of 66 preceding expenses during the time of 1988 to 2018. To place these profits in context, 100 put into the Medallion Fund reserve in 1988 would have changed over into $398 million by 2018. Even net of expenses, the asset has beaten S&P 500 returns by multiple times and Warren Buffett's profits by multiple times. So in this video, how about we investigate the asset, the man behind it, and what made them so successful? A ton of multifaceted investments administrators come from a foundation of business or money, and consistently that appears to be legit, since a mind-boggling information regarding those matters is what you would hope to need to oversee speculations. Anyway, Jim Simons had a conventional foundation in neither of those fields. Rather, he was a mathematician with a doctorate in his area. Eventually, he was selected to turn into the seat of the math office at Stony Creek College, where he helped foster the arithmetic and physical science programs, while as yet being pursued by organizations. For example, IBM for his counseling work. It was only after 1978 that he began digging into finance. In 1978, Jim Simons started the hedge fund Monometrics, which was the predecessor to the highly successful Renaissance Technologies. At 40 years old, at a little lengthy island strip shopping center, Jim and his group essentially exchanged currencies. It didn't happen to Simons at first to apply math to his business, yet he steadily understood that it ought to be feasible to make numerical models from the information he was gathering. Monometrics was renamed to Renaissance Innovations in 1982. Later on, Simons acquired algebraist James Hatchett from Cornell College. Hatchett extended Baum's models for exchanging currencies to cover any product future, and consequently Simons set up AX with his own trading account, Axcom Limited, which eventually gave birth to the profitable fund Medallion. This recruiting system of getting unquestionably the most brilliant mathematicians gave the mutual funds its edge. They didn't manage feelings and world news, just numbers. Renaissance utilized experts with non-monetary foundations, including PC researchers, mathematicians, physicists, signal handling specialists, and analysts. In a 2013 article in the Daily Telegraph, journalist Safras Manser described Renaissance staff as math geniuses running Wall Street of his 200 employees, ensconced enough fortress-like building in unfashionable Long Island, New York. A third have PhDs not in finance, but rather in fields like software engineering, material science, arithmetic, and insights. 1700s. Renaissance has been known as the best physical science and math division on the planet, and as indicated by Weatherall, try not to recruit anybody with even the smallest whiff of divider road bona fides, said the Message article. In a meeting, one of the investors in Medallion Funds faults the group-like attitude among business college graduates for poor investor returns. Programming and demonstrating are treated as the core of the association's benefit, not a cost. Assuming you wanted a ton of PC power, the choice depended on whether you wanted it, not the financial plan, says Peter Weinberger, previous boss innovation official in Renaissance. This approach was historic, harking back to the 1980s. As a matter of fact, some consider these techniques still exceptionally offbeat. Simon's secret and winning strategy has always been to remove emotion and focus on pure hard data using his mathematical background and large sets of data. Simon set out to build computer models that he believed could identify and profit from patterns in the market. His models depend on information from as far back as the 1700s, and they exploit even the littlest and briefest fluctuations in costs. The normal holding time frame in his portfolio is 2 days. The specific operations of the asset and the calculations they use have been a firmly maintained insider mystery. Anyway, the little we really do be aware of the firm comes from a book by Gregory Zuckerman called The One Who Solved the Market. Zuckerman, a veteran Wall Street Journal investigative reporter, tells the gripping story of how the fund was built from the ground up and what kept it so successful every single year. According to fund documents, the Medallion Fund employs a short-term quantitative trading strategy across multiple asset classes. These include global equities, futures, commodities, and currencies, according to a person familiar with the fund. It also tends to have high turnover and significant leverage. According to former co-CEOs Robert Mercer, Medallion only won 50.75% of their trades, but when dealing with millions of trades mostly on leverage, that's all it took to bring in massive profits too. It's assessed that emblem exchanges with 12.5 times influence on normal, with it going up to multiple times when the framework is certain. Assuming that you eliminate the influence from the image, the asset's profits are like the S&P 500. It's their compelling use of influence and profound comprehension of dangers implied that makes their profits unbelievable. By utilizing a huge number of elements of exchanges from previous years, Medallion has had the option to display. Another very important strategy they have employed is to cap their assets under management at $10 billion. The fund knows that any amount beyond that would be beyond the math used in the models and might not work as predicted. Therefore, the fund constantly pays out the returns to its investors to ensure it never exceeds $10 billion in assets. Now we as a whole have some familiarity with the functions of the funds. There have been various investigations and trials to decide the specific calculations the fund utilizes. Yet nothing has been convincing to date. Numerous New Age subsidizes today attempt to utilize comparable strategies of going by pure data and no different factors, but very few end up producing market-beating returns. While all stock exchanging is presently machine-based, algorithmic exchanging has been faulted for outsizing market swings and glimmer crashes. As quant contributing keeps on building up some decent momentum, SEC Administrator Jay Clayton told CNBC in September 2019 that the Public Authority Association is observing PC exchanging to ensure that exchanging today is, however, fair and straightforward, as it seemed to be the point at which it was voice exchanging. The SEC had previously monitored the Medallion Fund closely to ensure it wasn't another Madoff scenario. Simons typically accepts that quantitative exchanging is truly helping investors and the market all the more comprehensively by giving liquidity. By having a ton of quick exchanging, spreads have come way down, volumes have gone up, and accordingly it's simpler to get off an exchange since there's more volume. I believe it's truly cut transient unpredictability down, not up, so I believe it's been great for the market, he told CNBC in 2016. Now, on the off chance that you're thinking about placing all your cash into this asset, you've sadly reached a stopping point. The Medallion Funds has been shut to outside financial backers starting around 1993. At this point, just the current and past representatives of the organization can put resources into the asset. Also, with the high expenses that the organization charges, you need to contribute much more than the regular investor to make it worth your time. The fund charges an extreme amount of fees. From 2002 onwards, it has a 5 administration fee and a 4 performance fee. To signify the impact of this fee, let's take the following example. Assuming you put $100,000 into the funds, and toward the year's end your funds develops to $130,000, a 30% return, They would charge you $5,000, the 5% the management fee, and $13,200, the 44% of the benefit, for a sum of $18,200 in fees. So your net returns would possibly be 11.8%. Regardless of whether they lose cash, they will in any case charge you $5,000 for dealing with your cash. Simons maybe summarized his putting approach best of all in a 2016 interview, when he said he has no opinions on stocks, the computer had its opinions, and we slavishly followed them. He said the Medallion Fund is an interesting outlier to the understanding of the market, and to this day is an interesting case study. The fact that no one else has been able to replicate them should be a fair warning to not invest in any fund that claims to be purely algorithmic, because to this day no one has cracked what Medallion has succeeded in doing.